Hello everyone and welcome back to Velocity Channel, where we are your bridge to financial freedom. So an excellent question was brought up to me today, and that question is, how do we measure the velocity of debt elimination? Can you believe that? How do we measure the velocity of debt elimination? So that's what we want to get into right now. But before we do that, like, share, and subscribe so that everyone all around the world can know the power of their line of credit, of their checking account, their savings account, any banking tool, so that they can use it for debt elimination. Are you ready? So let's go ahead and get into this. Measuring the velocity of debt elimination. It'll take into account one specific formula, all right? Just one. And that's this: balance divided by cash flow. Now, with this, we need to keep in mind that there are some terms that need to be added on to the balance and the cash flow, all right? Balance is considered what? That's the payment you owe, right? So look, we're going to go ahead and put payment. Now, I'm not talking about minimum payment, right? I'm talking about the payment, right? Don't you owe, right, the $12,000 at 21%, $600 a month on your line of credit over here, right? The balance is $12,000. That's your payment, right? Especially if you pay all of it. So cash flow, what is that? Well, that's gonna be the money that's left over, right? Because you're using it as a velocity banking tool. The money that's left over each and every month in your line of credit, okay, in this circumstance. So what do we add on to that? Well, we can add on payment per month. Because what does the line of credit term that as? It terms it as a payment, not as a transfer like we determine it, right? What do I mean by that? Well, that means you're actually using this line of credit as your new checking account. So as that income comes in, you move it from your checking into your line of credit, and then you're paying your expenses from your line of credit. Now, whatever is inside there, the bank counts that as a payment per month, because that's how you're doing your finances each and every month, all right? So let's continue. Now, in school, they told us to cancel out some things when this happened, right? So what do we cancel out? Payment. So now all we're left with is month. So let's go ahead and bring it down here. Let's fill in the B and the C. We already know that the B is the balance, right? And then the C is whatever is left over in that line of credit, all right? So let's say $2,000 is left over in the line of credit. Now listen, you can add any number you want. This is the formula to measure the velocity of debt elimination, okay? We're also going to get to loans a little bit later in the video, right? So let's say it's 2K, right? Okay, balance divided by cash flow equals what? In this scenario, it's about, because of that interest, right? It's about 6 months you're going to have that debt, doing it the velocity banking way with that $2,000 in cash flow. Now, what happens, right, when your cash flow goes up? Well, it directly affects the measurement of the velocity debt elimination. Watch this. We'll turn that 2 into a 3, and we'll turn the 6 into a 4. Now you got about 4 months of that debt because of that $3,000 being left in there. Now, what can we conclude with this? We can conclude that there is a relationship between the months you have to pay off that debt and the cash flow that is running through that banking tool called the line of credit. Now, what if you had a loan? How do you do that? Because remember, loans aren't revolving. I mean, unless you know of any. Okay? So 12K let's say at 6%, because they're going to calculate it differently. I don't know, maybe 500 each month. Now, what would you rather do after you are done paying your line of credit off? Would you rather go ahead and have two of these, right? The line of credit and the loan to pay off? Or when your line of credit is paid off, would you rather say, you know what? I no longer want this cash flow sucking parasite on my books. So I think I'm going to take my $12,000, now that I paid the line of credit all up, I think I'm going to take the $12,000 and I actually want to turn this loan into a line. Why? Why? Because of the cash flow management. Write that down. Because of the cash flow management. When you turn this one directly away from you loan, right? That's where the money's going, away from you. When you turn that into a line of credit, you can pay, borrow, pay, borrow, pay, borrow. And guess what? Depending on your cash flow, you can pay that off and eliminate that line of credit much faster than you can with the loan, because of all that money that's going in, all that money that's going out, and that which is still there is what's paying that line of credit off. Now, quick disclaimer, you don't need a line of credit, right, to do velocity banking, but it is one of the tools we use to eliminate debt as quick as possible. So do you need an overview? Don't worry, here it is. We already know that there is a relationship between how much cash flow, right, that's what the C stands for, that is running through our line of credit and how long it takes, the velocity term, to pay off that particular debt. Now, why is that important? It's important because we're going to use our line of credit as much as we can, right, along with our checking and savings account. And if you don't have a line of credit, you can just use your checking and savings account to do what? Pay the principal. The principal is what we aim to eliminate. Because when you eliminate the principal, you eliminate the interest that comes along with the principal. Folks, you don't need to worry about the interest rates as much as you need to be concerned about, you know what? Let me write this down. Now, we say all the time, don't we, that interest feeds off of the principal. That the principal is the host and then the interest is the parasite, right? We say that all the time. But did you know that there is a bigger factor to look at than just the interest rate? A lot of people get scared when they mention 7%, you know, as far as the housing market is concerned. When they mention 20% or 30% or 40%, right? Well, look. You don't need to be concerned about the interest rate as much as you do this right here. Take a good hard look. Time and balance. Time and balance, because guess what the interest rate is doing while you're sleeping? It's accumulating. And then the next day, it's accumulating and accumulating and accumulating because of what? Time. But the interest is feeding off the balance, isn't it? Right? So that balance, right? The more you, let's calm down, the more you have in your balance, the more the interest is running away from you. And that's how they get you. And that's why some lines of credit, right? That's why some loans, they divvy it out in such a way to where the bank gets most of the interest. That's what we warn people about. That's why I say to talk to me, all right? We're here to let you know about these things. So keep that in mind, time and balance, way more to be concerned about than just the interest rates. There's so much more, folks. And if you don't want to write this stuff down, you don't have to. Get the automated Velocity banking solution. Let me know about it in the comments below. I got my link, right, to schedule a talk with me for your discovery call to see if you even qualify for the solution we're talking about. All right. God bless, and you guys have a great one.